Hey everyone, welcome back to Dividend Talk. One of my key objectives as an investor is to build long-term wealth through dividend growth investing. And honestly, I believe in doing this with a portfolio based on safe dividends. Talking about safe dividends, the best place, in my opinion, for any investor to start is with the Dividend Aristocrat list. These are companies that have increased their dividend for at least 25 years and have shown that they can weather many economic cycles while growing their business and in turn growing their dividend. I think one of the key misconceptions people have of dividend investors is that we focus too much on the dividend, but actually as a dividend growth investor, I believe that fundamentals are really important and I like to focus more on the three financial statements, and if these are strong, it's usually a good indication that the dividends can continue to grow through many different economic cycles. Now with all that said, I won't keep you too long, so let's jump inside and have a look at 5 dividend aristocrats that I think offer really safe dividends and are currently undervalued compared to historical valuations. So the first company on my list of dividend aristocrats that I feel are undervalued with a safe dividend is Target Corporation, ticker symbol TGT. Now Target is one of the most recognizable brands in the US, and actually even over here in Europe, my niece constantly talks about wanting to visit Target. She sees it on YouTube all the time, and honestly, I had to do a video when I was there one time just to show her that Target was a real place in America. The company have over 2,000 stores in the US and they have a diversified product range. They have the lower margin business such as your frozen goods, dry goods and your normal perishables, but they also have this higher margin business which is their clothes, home decor and even electronics. One of the best things that I like about Target is that they continue to try and evolve with the times, and they've shown this with their online presence, which they are heavily improving to try and drive long-term growth. I know most of you will probably know a little bit about Target, but here are some reasons why I think they are worth looking at as an investment. The first reason is that they are a dividend king. They have over 50 years of dividend increases, and honestly, that is hard to beat. The company have a really simple dividend policy which says that they have paid dividends every quarter since 1967 and they intend on continuing that into the future. Along with a long history, they have a current dividend yield of 3.8%, which is quite high for Target. Their 5-year growth rate is 11.3% and their payout ratio is 50%, which actually gives them a lot of room to continue to grow that dividend even if they run into 1 or 2 years that underperform based on the last couple of years. And all of this is supported by plenty of cash flow generation and a strong balance sheet. Now the second undervalued dividend aristocrat is no other than Johnson & Johnson, ticker symbol JNJ. Now I don't think Johnson & Johnson needs much introduction, as honestly we speak about them quite a lot on our podcast. We always analyse their earnings every quarter, and honestly it's been like clockwork since we started a podcast way back in 2020. Now the company are diversified within the pharmaceutical and medical devices industry, but if you know me, I was a little bit critical of them selling their consumer health business, as I thought at the time that gave them a little bit of stability. However, it is hard to argue with a AAA balance sheet. Now one of the best things about having such a strong balance sheet is the ability to grow your dividends over time, and Johnson & Johnson have grown these dividends for over 60 years, making them a dividend king just like Target. You can currently buy Johnson & Johnson for a 3% yield and you're likely to get a 5.5% dividend growth rate, which they have done for the last 5 years. So I could talk for a long time about Johnson & Johnson. They have one of the strongest balance sheets that you will ever see. They have got really strong cash flow generation. They've got a really good dividend history. So for me, at a 3% yield, Johnson & Johnson is a really compelling investment choice at the moment. Now the third undervalued dividend aristocrat that I have is Stanley Black & Decker. Now this is another company with a dividend history of over 50 years. And honestly, I'm starting to think I should rename this video to Dividend Kings and not Dividend Aristocrats. But you'll see in a few minutes that they're not all kings in this video. Now Stanley Black & Decker are famous for power tools and they cater to both professional and DIY consumers. Now along with 50 years of growth, the company currently trade at a 3.8% dividend yield. Now this dividend yield is supported with around a 4% 5-year dividend growth rate, which honestly might be a little bit on the low side, especially for me, but it's hard to argue with the consistency of paying dividends for over 5 decades. So a couple of things that I like about Stanley Black & Decker is that they continue to innovate to meet the needs of consumers like me. Along with that, they are in both US and international markets, which I feel gives them good diversification, and I also like the fact that they cater to both professional customers and also DIY enthusiasts. I think they're well diversified and well balanced, and if they make the right acquisitions, they can continue to see long-term growth. Now my fourth undervalued dividend aristocrat is Archer-Daniels-Midland, ticker symbol ADM. Now ADM is one of the world's largest agricultural processors, and they supply essential food ingredients worldwide. Now when you think about it, the population of the world is only going up and up, and as this demand for food increases, ADM will play a crucial role in that supply chain. Now ADM are the first company on my list not to pay dividends for over 50 years, but as a dividend aristocrat, you have to say that over 25 years of increasing dividends is not too bad. Now the company currently trades at a 4.2% dividend yield. And the reason that it's so high is because recently, well maybe not that recent, but over the last year, they've had a little bit of a scandal in terms of their accounting. Now that's probably not the only reason why the share price is a little bit depressed. We've also got high interest rates, we've got inflation, we've got supply chain issues, we've got a whole host of stuff. But honestly, at a 4.2% yield, it's really hard to ignore a company like this, especially when the dividend growth rate over 5 years is above 7%. The company generally have a low payout ratio of between 35 and 50%, meaning there's a lot more room for them to continue growing that dividend. And with the strong global demand for food, I'm confident that their stable cash flows will remain and their dividend is safe. Now the last undervalued dividend aristocrat on my list is Realty Income, ticker symbol O. Now I've been speaking about this company quite a bit recently, so I won't go into too much detail here. But at the moment I feel like they're really attractively valued, especially with a 5.6% dividend yield. Now for a company that calls themselves the monthly dividend paying company, you have to believe that the dividend will be safe for many years to come. Now there is a downside. The dividend growth rate is only around 3%, so it's not growing super fast. But with a near 6% starting yield and a commitment to growing these dividends every year and paying them every month, I think this company is a safe bet to hold in your portfolio to slowly compound that income over time. So there you have my top 5 undervalued dividend aristocrats that I believe have a safe dividend. Now I've chosen these companies using a number of metrics, including checking their current dividend yield versus the 5-year historical average. Personally, I think for a beginner investor, a dividend aristocrat list is a great place to look. But what I'm curious to hear from you is what company would you replace in this list and who would you replace them with? And as always, if you like these type of videos, please leave a comment below, hit that like button, and if you're feeling generous, also hit that subscribe button. See you next time.